Hello and welcome back. Today I'm moving to answer question number 3, Advanced Financial Management, the paper that was done in April 2022. Question 3A, I read, Modigliani and Miller suggested that real-world considerations, primarily institutional constraints on high leverage, would prevent firms from approaching 100% debt levels required. Giving reasons, explain whether you agree with the above statement. Question 3A. April 2022, question 3A. Reasons. So, is it true that, the question is it true that firms would be prevented from approaching 100% debt levels? We know that debt is a cheap cost of finance to most companies. The question is, if debt is cheaper than the other sources of capital, then why is it that most companies' capital structure do not contain 100% debt finance? There are reasons why that is the case. Giving reasons, explain whether you agree with the above statement. I agree with the above statement, and these are the reasons. The first reason why companies do not have 100% debt level is because of the debt covenants. All right? Debt covenants. Number 1, debt covenants. Debt covenants. Now, lenders may restrict a company through debt covenants, resulting to decision inflexibility. Before a company borrows, there could be a condition that the leverage of a company be, say, 50% or less. That is a restriction. Before you get more funding, financial institutions would want to check your leverage level before they advance more debt. So that could be the one reason why companies do not have 100% debt levels. The second reason is that is in relation to risk. Risk. Now, the managers that are risk averse may be reluctant to borrow more debt. Risk averse managers. Risk averse managers may be reluctant to do what? To borrow more debt. We know some managers are aggressive, they will go for more debt, but others could be risk averse, they would avoid debt. So that, because of that attitude of being risk averse, then that can limit companies to have 100% debt levels. The other reason may be in relation to the lenders. Lenders may also be reluctant to lend too much. Why? Because the company becomes riskier as more debt is borrowed. The lenders may be reluctant to lend too much debt, since company may become riskier when more debt is is borrowed. So these are reasons. Any two would earn you the 4 marks. Any two reasons here, 1, 2, would earn 4 marks. Now, moving on to part B of the question. Part B reads, an unlevered firm operates in a perfect market and has a net operating profit of 4 million shillings. The required rate of return on assets of this firm is, in this industry, is 16%. Assume that the firm issues 10 million shillings worth of debt with a required rate of return of 14.5% and uses the proceeds to repurchase outstanding shares. There are no corporate or personal taxes required. Roman 1. The market value and required rate of return of this firm's shares before the repurchase transaction according to MM proposition number 1. 2 marks. Part B. Roman 1. We are to calculate the market value of this firm and the required rate of return, 2 things. So the market value of the firm, we know the formula is EBIT over the cost of equity. EBIT over the cost of equity. And this is the cost of equity of the unlevered firm. This firm is unlevered. All right? And therefore, the earnings before interest and tax is 4 million. The cost of equity is equal to the required rate of return, which is 16%, 0.16. So that will be the market value of this firm. 4 million divide 0.16. It's 25 million. That is the market value of this firm. The next requirement is the required rate of return. The required rate of return of these firm shares before the repurchase. The required rate of return. The required rate of return. The required rate of return. The required rate of return of the firm shares. The required rate of return of the firm shares. The required rate of return. Required rate of return is equal to W, the weight of KE, plus the weight of KD. There are no taxes. All right, there are no taxes. So candidate, the required rate of return of an unlevered firm is the same as the the weighted average cost of capital. So the weighted average cost of capital will be equal to the weight, which is 25 over 25. This is the weight. There is no debt. So 25 times 25, the cost of equity is, we read the cost of assuming the firm issues that required rate of 14, this is 16 plus 0. This will be equal to 16%. So the required rate of return of an unlevered firm is equal to the weighted average cost of capital, which is equal to the weight of cost of equity plus the weight of debt. But since the firm is unlevered, there is no debt. That's why I've put here 0, and therefore the weighted average cost of capital of this firm is 16%. Now moving on to part 2 of the question, the market value and required rate of return of this firm's remaining shares after the repurchase transaction according to Proposition 2. So the market value, this is Roman 2, the market value, or let me just say the value of the firm will be equal to the value of equity plus the value of debt. Value of equity plus value of debt. The value of equity plus the value of debt. Now, the value of equity is, after repurchase, is 15 million. And the value of debt after repurchase is 10 million, which is equal to 25 million. Because we read that assuming the firm uses 10 million worth of debt with the required required rate of return of 14%, and uses the proceeds to repurchase outstanding shares. So the value of the firm is still equal to 25, is the value of the firm. The next part we need to answer is the required rate of return. That is the cost of equity of a levered firm. This firm is levered because there has been introduction of debt in the capital structure of this company. This will be equal to the cost of the unlevered firm plus the cost of the unlevered firm minus the cost of debt times the debt equity ratio. The cost of unlevered firm, we had calculated it here, 16% plus 16% minus cost of debt 14.5% from the question times the debt equity ratio. The debt is 10 million, equity 15 million. This is equal to 16 minus 14.5 times 10 divided by 15 plus 16. So this gives me 17%. So 17% is the cost of the levered firm of this company. Now moving on to part C, I read, summarize 4 disadvantages of using future contracts as financial instruments. Future contracts, part C. Disadvantages of future contracts. Now, what are future contracts? Now, candidates, a future contract is a standardized derivative contract that is created and traded on the futures exchange, in which 2 parties agree that one party, who is the buyer, will purchase an underlying asset from the other party, who is the seller, at a later date and at a price agreed on by the two parties when the contract is initiated, in which the exchange, in which there is a daily settling of gains and losses, and there is a credit guarantee by the futures exchange through its clearing house. So it is a contract in which two parties come together, a buyer and a seller. It is a standardized derivative contract that is created and traded on the futures exchange. And there are two parties who agree that one party will purchase an underlying asset from the other party at a later date. That's why it's referred to as future contract. At a later date. So what are the advantages of future contracts? Do you understand? Now, the first, disadvantage. What is the advantages? The first limitation or the first disadvantage of future contracts is that there is only a limited number of currencies. It allows limited number of currencies. Futures contracts allows a limited number of currencies. Only a limited number of currencies are the subject of futures contracts. Although the number of currencies is growing, especially with the rapid development of economies in Africa, economies in Asia, and so on. So it allows a limited number of currencies to be traded. You may find maybe dollars, euros, and so on. That is futures contract disadvantage number one. Disadvantage number two is that there are what we call hedge, it leads to hedge inefficiencies. Hedge inefficiencies. Hedge inefficiencies. Hedge inefficiencies. These inefficiencies are caused, the hedge inefficiencies are caused by having to deal in a whole number of contracts, and because of what we call the basis risk. And that is the risk that the future contract price may move by a different amount from the price of underlying currency or the underlying commodity. So those who trade in future contracts have to bear with the hedge inefficiencies, which is a limitation of the futures contracts. Number three, unlike options, they do not allow a company to take advantage of favorable currency movements. Do not allow, the futures contracts do not allow a company or a person who engages in it to take advantage. It does not allow the players to take advantage of favorable currency movements. Companies do not allow companies to take advantage of favorable currency movements or changes. Because the price is locked. Okay? The price is set today. So that when there are favorable foreign exchange changes, then the parties cannot take advantage of such movements. So that becomes a disadvantage. Number four, the contract, the futures contract cannot be tailored to the user's exact requirements. Cannot be tailored to the user's exact requirements. Futures contract cannot be tailored to the exact user's requirements. That is candidates that the futures contracts cannot be standardized as the requirements of the users, and that becomes a limitation. These are 4 disadvantages of futures contracts. 1, 2, 3, 4. 1, 2, 3, 4. 4 marks. 4 marks. Then part D, the currency market price per ordinary share of Kanga Limited is 58 shillings. A call option exists on the company's shares with an exercise price of 52 shillings and with the 6 months to maturity. The option can only be exercised on maturity, that is, it is a European option. The risk-free rate of return is 6% and the variance of the rate of return on the shares is 15%. Required, using the Black-Scholes option pricing model, estimate the value of the call option 6 marks, and down there the formula for Black-Scholes option pricing is provided. The formula is given for the value of a call, that is D. The value of a call, the formula is given, is equal to the standard deviation N D1 minus strike price E negative RT T and D2. This is D2. That is the value of the formula for value of a call using the Black-Scholes formula. So first of all, we are going to calculate D1, and we know the formula for D1 is equal to the natural log of ST over exercise price plus the risk-free rate plus the variance. This variance, you divide it by 2, then we multiply this by T. Multiply by T, divide by the standard deviation times the square root of time. So, candidates, ST is the underlying asset price, X is the exercise price or the strike price, RF is the risk-free rate, this is a variance, T is the time, this is standard deviation, and that is square root of time, So let's substitute the values. The values, we're going to have the natural log of 58 over 52, the asset price and exercise price, plus the risk-free rate is, from the question, risk-free rate is 6%. Yes, 6%. Converted into decimal, 0.06. Then we add, the variance is 15%, converted into decimal, 0.15. This is the variance. We divide the variance by 2. Divide this variance by 2. This variance we divide by 2. The bracket is here. Then multiply by time. The time here is 6 months. 6 months over 12 is equal to 1.5, which is equal to 0.5. So the time is 0.5. So we're going to divide that by the standard deviation. And we know standard deviation is equal to the square root of the variance. Square root of the variance, our variance here is 0.15. Then the square root of time times square root of time, 0.5 times 0.5. So this will be equal to, we go to the calculator. The natural log is in the calculator. So you punch natural log, open a bracket, 58 divided by 52. Close the bracket. This is equal to 0.1092 plus, we remove this bracket, that is 0.15 divided by 2 plus 0.06 times 0.5. This is 0.0675. Divide the square root of 15 times the square root of 0.5, 0.3873 plus square root of 0.5, square root 0.5, 0.7071. This should be equal to, so let's add 0.1092 plus 0.0675 divide, open bracket, 0.3873 times, this should be times, multiplication sign, times 0.7071, getting here 0.65. That is D1. Then D2, the formula for D2 is D1 minus the standard deviation times the square root of time. And we have the D1 there. So D1 0.65 minus the standard deviation, I said, is the square root of the variance, 0.15. The variance 0.15, the variance, times the square root of time, 0.5. 0.5. So D1 therefore will be equal to 0.65 minus 0.15 times 0.5. This is equal to 0.38, or let me call it 0.37. This is D2. All right, D2. Let me take it again to be sure here. I have square root of 0.15. This is 0.387 times the square root of 0.5, 0.707. So this subtract from 0.65, minus 0.387 times 0.707 is equal to 0.37. Correct, 0.37. Now we've done D1 and D2. D1 and D2. The next step is to move to the distribution table, the normal distribution table, and put down the values for 0.65, 0.65, 0.65, 0.65, this value here. So we are calculating D1 and D1, normal distribution, and D1 candidates, given that this is a one-tailed standard normal distribution and it is on the right-hand side. The tail is on the right-hand side. Therefore, our figure here will be 0.5 plus this is 0. We are getting 0.D137, 0.37. This is 0. I'm reading from the tables, 0.1443. Then ND2, same thing, 0.5 plus 0.37. This is 0.37, 0.37 is 0.1443, and 0.65 should be 0.2422. This should be 2422. D1 2422. D1 2422. D1 is 0.65. 0.65. D1 0.65, 2422. Correct. Then D2 0.37, 0.37 1443. That's correct. So our values will be 0.5 plus 0.2422, 0.722. Then the 2.5 plus 0.1443 is equal to 0.6443. Now these are the values. We're going to substitute the values into the main formula. The main formula, we have the ND1. Our ND1 is 0.7422. So here we substitute the values in the main formula. This is the underlying asset price, we know is 58. Underlying asset price 58. D1, we have it there, times 0.7422 minus the strike price. The strike price is 52 shillings. 52 shillings. We multiply by the D2, okay? D2, we multiply here 0.6443, right? 443 raised to the risk-free rate 0. And candidates, here you need to be very careful because we have the E, which is a base of the natural log, the base of the natural log E raised to 0.06 times T 0.5. So we've done the substitution. 58 is the underlying asset price. This is the D1, okay, after reading it and adjusting the normal distribution 0.7422 minus the strike price, also known as the exercise price. We multiply by the D2. This is D2, which we calculated here, D2. Then this is the base of the natural log raised to the, is the base of the natural log raised to negative, this is negative R, the risk-free rate, times time T, 0.5. So we come and insert the answers there. 58 times 0.7422 is 43.05 minus 52. I come here, type 52 times 0.6443. Then I press shift, natural log. Then I insert bracket. After this E, make sure you have a bracket. This power, have it in bracket, minus negative. That is minus 0.06 times 0.5 times 0.5, close the bracket. So this gives me 32 0.5. And therefore, the difference will be the value of this asset, 43.05 minus 32.5. So this, the value here is 10.55. 10.55 shillings. That is the value of the call. The question is, using Black-Scholes option pricing model, estimate the value of the call option. So the value of the call option is 10 shillings and 55 cents. So that is how to calculate the value of a call option. The first thing to do is to put down the formula. There are times the examiner will provide the formula, as was the case here. So this is the formula. There are two things, this minus that. Then within this formula, these inputs must be calculated. So we need to have a workings. These are workings. These were my workings. Working 1, working 2, working 3, working 4. These are the variables that are needed in the calculation of the value of call option. How many marks? 6 marks. 1, 2, 3, 4, 5, 6. 6 marks. Then for part 2, these are 4 marks. 4 marks. 1, 2, 3, 4. 4 marks. Then B1, just 2 marks. So 1 mark for value of the firm, 1 mark for the required rate of return, 2 marks. Part A, 4 marks. So we answered question number 3 that was tested in April 2022. The subject is Advanced Financial Management. I want you to go and try out question number 4, but before you move on to question number 4, go to the revision partners. The revision partners, we have done past paper questions still on the same area, all right, the Black-Scholes. Make sure you also revise these areas by answering similar past paper questions. Then you can move on to question number 4 before you come to our next session. Thank you for your patience. I hope to meet you in our next session where we'll have a look at question number 4. Thank you. God bless you. Bye-bye.